good morning. Welcome to the IA Investment Management Macroeconomic and Fixed Income Update. Today, I'm speaking with Dominic Siciliano. Dominic is Senior Vice President, Head of Public Fixed Income at IAIM. My name is Rose Marcello, and I'm Director, Client Portfolio Manager. Dominic, welcome. Thank you for being here.
Thanks, Rose. Great to speak to you again.
Yeah. So markets have been rattling, let's say, and there's a lot of worries. One common worry for individual investors is that the bond market is complicated. Could you tell us more about the bond pricing mechanism in the public market?
Yes, there's a lot of misconceptions on how the bond market works. So, contrary to a listed market, you might say, no, I don't see visibility in the pricing. But what clients need to understand is that the same participants that price the equity markets are the same participants that are on the bond side. So we see a lots of liquidity on government securities, and we have the ability to trade, with these counterparties. There's no transaction fees when we trade, contrary to equity also. But it's a very transparent and liquid market for the people that are participating within the market. So that's not as much a concern. I think also clients and investors are always confused with, I invested $100, I'm going to get that $100 back at the maturity of the bond, but why is my $100 fluctuating if I'm getting it back on a day on day 5 or 5 years? So in bonds, you have what you call a coupon and you have your principal amount. And when you're dealing government securities, we're pretty sure that we're going to get the principal amount back at the end of the maturity. But there's a mark to market that is subject to fluctuations due to the interest rate. So if we take an example, maybe that's close to home, just to give you how the dynamic works with the principal amount of your bond, it's sort of like interest rate on your mortgage. As interest rates go lower, you might find the valuation of your house starting to climb as people have more access to capital at a lower rate, and the valuations go up. And as interest rates go higher, what happens? People have a bit more difficulty getting approved, or the financing is more difficult, and then you might see some stagnation or lowering in price in your house. Now, in the housing market, it's supply-demand mechanics that determine that principal value of your home. On the bond side, it's the Bank of Canada. When they raise rates or lower rates, they're acting a little bit in that same fashion, trying to regulate the economy, the overheating or the slowdown of the economy, and that's something that reevaluates your principal. But if you hold it to maturity, you will get back your principal and receive your coupon. The other aspect that people need to realize is that in the last couple of years, with everything that happened in the markets and with central banks lowering rates to basically zero, the coupon, that little protection you get, the payment, was very, very small. So any fluctuations in interest rate had a huge impact on the valuation of your bond because the principal was moving a lot faster than the coupon adjusting. Now, coupons are much higher, and we finally have a bit of a cushion in the bond market where, we've had these rate hikes very quickly, but the coupon will start to act as a buffer moving forward for bond investors.
Great. And just to be clear, that price fixing mechanism on the secondary market for bonds is very transparent. It's a mechanical, almost mathematical process, right?
Absolutely. You incorporate credit. There is a knowledge of what the risks are associated to a specific company. But when you're dealing with government securities, whether it's provincial CMBs or Canada's, most of the times it's very mathematical. Where's the Bank of Canada overnight rate? What is the projection for the future flow of rates? That we call it in the term the curve. And then it's just mathematical with the time left on the bond to get a good idea of what the valuations are. And then there's also a liquidity factor. If you want to buy and sell, there are people making markets and they have to make money by doing that. But it's a very tight market and very transparent on the government securities.
So very liquid. So returns have been pretty bad this year. Let's say we're in a bear market for global bonds in 2022. Not what we'd expect, but what makes this year exceptional or an outlier?
So we get this question a lot. I bought bonds, stock market is collapsing, the bond should protect me. And that works most of the time. And if you look at the graph on the that we're showing right now, you'll notice that it's really an anomaly to have everything correlate to 1 or -1, depending on how you look at it. So the reality is that bonds and equities are not protecting you, but all asset classes are under attack. Everything is red. The reason for that is inflation. When inflation is way above the expectations of the central bank, it causes mayhem in the markets because you have no price certainty. You go to the grocery store, is your bill going to be $100 this week or $120? You don't know. You're really subject to fluctuations, and that leads to uncertainty in the market. So all asset prices are coming under attack. But once we've normalized inflation, and I think if you look at the forecasts for the next 3, 4, 5 years, there is a normalization process for inflation. At that point, that dynamic will come back, and the relationship between, let's say, asset classes, that correlation will normalize and return. I give you an example for your home. Once again, if you ask your contractor to build you a deck right now, they might have a hard time fixing you a price because they don't know the price of lumber or changes in the labor costs because of all these variabilities due to inflation. So that's why the central banks have been so aggressive, and this is unprecedented in terms of the aggressive nature of all the central banks, because they want to crack down not to have situations like in the 90s repeat themselves in the marketplace. So we're aware of that. It's a bit of a difficult time for everyone. We're not having fun in these markets, but I think if you look at it over the mid and long term, there's still a lot of opportunities here given the repricing in the marketplace.
Good to know. So, steady trend higher for yields. What would be the catalyst for a peak in rates right now, and where do you see value in the bond market?
So the volatility that's creating this valuation change across all markets is sparked by the central banks raising rates, and they're doing it very, very fast. So there is a lag impact between the time they raise rates and the impact. You might not have your mortgage due until next year, so you're not necessarily feeling the pinch of the higher interest rates, but you are going to feel it in March when you renegotiate. So we think that this is going to lead to less money in people's pockets, and eventually this is going to lead to a recession. How deep the recession, we're still trying to get our heads around that, but we will have a recession because of this. And I think that's when we talk about central banks wanting to crash land the plane or slow down the economy. Often it's not easy to do that. So we will have a recession. As we approach the recession, that's when interest rates will peak. And we think that this is not far off from being a story for probably in the first or second quarter of next year. So we are presently finding value in the bond market. We think that here at these levels, it's a good place to start to go overweight, given where 10-year rates are and 5-year rates are in the market right now.
Great. So it's a very dynamic process, and despite popular belief, fixed income is not just a buy and hold strategy. So how do you and your team add value in such a market configuration?
So, there's different layers of the fixed income market. There's, the credit aspect, the government aspect, and how rates move along the curve. So what short-term rates are doing and long-term rates. So as a portfolio manager and our team of portfolio managers, we're always trying to optimize that positioning with the view of the marketplace. So over the big course of this year, we've increased the quality of our portfolio on the corporate side, because we say if we go into recession, maybe we'll have a little bit of nervousness relative to profitability of certain companies, and maybe spreads might widen a little bit. So we've been increasing the quality and reducing our overweight in corporate credit. And as such, we have increased now our duration, because we feel that the portfolio at these levels, the coupon is giving us a better cushion or a better risk reward to be long duration. And we're going to slowly start to get back into steepening trades, that is, buy short-term rates, because we think that the banks will at one point have to stop the rate hikes, and then this will create a recession, and then they will go the other way. So when they start lowering rates, will we be well positioned to capture the reevaluation? We talked at the beginning of the conversation, that $100 par that right now is maybe worth $80 because of rates. Well, if they decide to cut rates, that $80 is going to quickly go back up. If you just look in June, when we closed the markets on June 30th, from June 30th to and it's a broad market, so it's different for every portfolio, but till the end of July, the market made 4% return just in 1 month on that lowering rates. We gave some of it back recently, but it tells you that you have to position yourself for the next move in the marketplace. And I would tell clients don't chase yield. Build your investment plan with your advisors, with your cash flows. What do you need for the future? If you don't need your money today, it's a great time to be in the market. There's a lot of interesting valuations, whether it's equity or bonds. And if you need the money in 10, 15 years, I don't think you'll regret locking in these rates at these levels. Obviously, if you need money to pay for your child education in the next 3 weeks, you can't invest the money in the same thing. So don't chase yield. Look at what you need to invest along your future cash flows, and then pick the best yield according to those terms that you need. And talk to your advisor to make those decisions.
Once again, stressing the importance of having the right profile for
Yeah.
yourself and discussing that with
Absolutely.
your advisors. Well, thank you so much, Dominic, for taking the time today.
Thank you, Rose. Have a wonderful day.
Thank you, you too. Bye.